Welcome back to the Finance Corner. So this is going to be an update video in our options account where we are trying to flip money slowly using the options wheel. So, today is Sunday, April 19th, and we got a quick update. We've been making some plays. So we can see we're not exactly back at our starting balance yet, which is 7,500, but we're not too far. A big reason for this is because of the Kohl's shares that we're holding is finally starting to recover a little bit. If you remember, our cost basis was actually $19 here. So you can see, if we just do this quick math, let's do the handy dandy ruler tool. We're down still currently about 23% on Kohl's shares. So, when that appreciates a little bit more, we'll be able to get our money back above 7,500. But we've been making some plays here and we can talk about it. So let me go over to what we've been doing here. Now, I think in the last video, the last update video, the trade I explained was this one where we sold the quadruple U put for April 2nd, and then we managed to close that for about $45 profit. And that was what we did. So here's the next thing. Here's the next couple things we did. So again, I like UUUU and their volatility. And I also like, honestly, like their business model and the fact that they're an energy company. And energy has just been going crazy for the past couple of months because of everything going on in the war. So a lot of volatility. I think a lot of premium to be collected in this ticker. So first thing I did, I think I tried to write a put here, another one for, yep. So basically, this I sold a quadruple U put, $18.50 strike price for April 10th, which is actually my birthday. I turned officially young status. I'm now 30 years old, which is crazy to think about, but we here. So we did that, and then you see this contract is canceled here because I tried to get a little bit higher premium for it, which is $1.52, and I'm sticking with the two contracts for now because as you can see, we're able to collect some nice premium. So here's the trades that I did get filled on. We did a same $18.5 put, expiring April 10th, and we did this with like 3 days out because you see we put it on the April 7th, and then it expired on Friday. So we actually closed it early. So as you can see, here's what we did. We sold the put and we collected $2.94. Or for being very specific here, I collected $1.47 times two contracts, which is $2.94. And then remember, options are leveraged instruments. So I actually got $294 for writing that contract. Now, after, we can actually take a quick look at the price action for UUUU because it's actually been fairly bullish. I remember saying that this zone here, I can expect some bullish moves out of this zone, and we're kind of getting that. I remember saying that around here, and we're kind of getting that, which is very good. My TradingView subscription ran out. It's calling me broke, so we get ads. And so yeah, I liked how we got this bounce out of this zone. Very beautiful. One thing I mentioned, or one thing I like, these arrows here. Let me just explain them. So with my technical analysis strategy, I use smart money concepts in combination with other things. But I like this divergence here because, as you can see, the low that we made on March 16th was around 1639. We actually made another low 2 weeks later, lower than that, right? So we swept that liquidity from that low here. But I want you to notice, pay very close attention to the bodies of the candles. You see how the wick on this week here, March 30th, got lower than the wick 2 weeks ago? But look at where the body actually ended up on the candle. So you can see the bodies of the candles are actually going higher, while this one time we just got this one sweep. So this gives me confidence that we're still kind of bullish coming out of this area. So let me explain the trades that I did, because this is kind of what I was looking at, and I was like, oh, maybe we can get a nice bounce. Go back to the daily chart here. So we did get a nice bounce. And what I was doing is selling puts in a $18.5 strike price. So you can see here, got paid the 294, and we actually closed the trade. Excuse me. So we sold to open, right? We sold to open this same put, and then we bought to close the same exact put. So you sell to open 18.5 put, $4 April 10th strike price or expiration, and then we bought to close 18.5 strike, same expiration. But as you can see, we paid a lot less for buying to close it. So if you just do that difference out there, just do handy dandy calculator real quick. So 294 minus 66 means I got $228 and collected premium from this trade here. So that was beautiful. We didn't get a sign, collect the premium, on to the next one, right? So I actually did it again. So we did. So now you can see the price is actually going a little bit higher. So this contract was written on April 13th. So we got that on Monday of last week. And you can see Monday was a nice big green day. So I think I actually timed that trade perfectly, because what I did was, does it have the time? Yeah, there we go. So we got filled at 9:48 a.m. So I'm actually show you how perfectly I timed this trade. 4:13 and 9:48 a.m. Let's look at that real quick. So if we go over here, where are we at? April 13th. So as you can see, 9 o'clock. This is the 9 o'clock candle here. You can see the timestamp at the bottom of the screen, but this is the 9 o'clock candle, right? I sold that contract, and what we did was we sold a $19 put. We sold the $19 put, and as you can see, the premium was actually paying $1.35. It's actually not bad, not bad premium, right? We got filled at 9:48. What happened? We got filled. You can say around this price. Maybe let's be a little bit more specific. On the 15-minute chart. So we got, zoom out a little bit. April 13th. Yeah, this beautiful move here. So as you can see, market opens at 9:30. We did a nice drop down into $17. Came all the way back up. And around this price, around this time, when the price was at like $18.30, this is around the time that I sold the contract. Now, the reason why that's important is because it was actually a perfectly timed trade. Because if you can sell a put when the price of the underlying is lower, then you are going to get paid a nice premium. And if price goes up immediately after you write that put, that's an extremely favorable scenario for you. So as you can see, I didn't even hold this trade that long. So we had the expiration date out for, we opened it on Monday. We had an expiration date for Friday, but I ended up closing it tomorrow, as you can see. So tomorrow, 4/14, 9:52 a.m. is when I actually closed it. So same concept here. Same concept here. We sold to open, $19 strike, 4/17 expiration. We got paid $270, right? And then the price of the underlying went up by the next day, like crazy. So even though we had 3 days left on the expiration, look how much cheaper the premium was. And so I have a rule where I want to only collect, because again, the goal of this account is to do literally just this. My goal is to just grow the income and generate income on it. So what I want to do is I don't want to get assigned if I don't have to. So I just closed this trade, even though like we still had some time left. I could have maybe collected the extra $44 or whatever, but it makes no sense because the rule that I'm trying to follow is making taking at least 75% profits, 75% and up on the profits. So just to give you some math here, if 270 was the price that the amount of money I got paid, if I only want to keep 75% profit, you take 270 times 0.75, and you can see I'm only looking to make about $200, $202 on that trade. So we actually got a little bit more based off what the price we got filled at when we bought to open or bought to close. So you take 270 minus 44, and we got paid the difference of 226 on this contract here. Now let's talk about where we at currently. So those are two successful, collecting premiums that I did over the week. Now I tried to do another. So here's where we got a little bit more riskier. We got a little bit more riskier. So what I did, right? We tried to. Anytime you see the limit is canceled, it was me trying to get a higher price, a higher premium, but I just didn't get it. So, we tried to get 190 for this, but we ended up getting 175. But here's the contract that I'm currently in right now. We sold a quadruple U put with a $22 strike price and a expiration date of April 24th, which is the end of this week, Friday coming up. And we wrote this on the 15th. So as you can see, what was going on in the price of the 15th? For the 15th, I don't know why they put it back so much. Put it back like crazy. All right, the 15th. Yep, that was after we got this big move. Yeah, exactly. So the 15th was here. We're already at $20, and like the range for the day was like $20, and the high of the day was like $21.30. So we're already, higher. And if I took I can't really show you the option change like what the premium was paying me back then, but you kind of have to go a little bit out of the money since I wanted to get a higher premium, and that's basically the contract that I wrote. So the goal of this contract is that, let me write it out, by by March 24th, we need to see the strike or the underlying. We need to see the price be above $22. That's the goal for me to be able to keep as much premium as possible. Because right now we're actually down on this trade. So we wrote it on the 15th, and we did the $22 strike price. And as you can see, we got paid $350 in premium because we did 175 times 2. But now the problem, or the reason why we're down on this right now, is because the stock kind of lost its momentum. And as you can see, it started selling out. Like it was just about to hit 22, and then it just started selling off here. But we got some fundamentals to talk about real quick. Got some fundamentals because as you can see, this all happened on last week's price action from Friday. We trade a little bit higher and then came back down. But I don't feel like looking through Reddit to find the post. But basically, there was an update on the weekend in terms of the war, as there is always. And it's funny how it's like we get these big updates when the market's closed, so people can't take advantage, right? It's very interesting, right? But we got the speaker of Iran actually made a post on Twitter how the strait is going to is basically got closed again. The Strait of Hormuz got closed again, and they're going to be enforcing that. So, and that this happened on like Friday after market close. So it's going to be interesting to see how market prices open up this week. It's going to be actually very interesting to see, because if we can take a look at oil here, just what's been going on is that like Trump made the U.S. military kind of take over the strait, and since then you can see like oil has just actually been dropping. So it was sitting at like over $100 a barrel, and then this week, so you can see this whole week, Monday is a high of 105, and then it just kept dropping like crazy. Now we're back at like 83. But with this announcement that the strait is now closed again, uh, I'm gonna I'm gonna try to find that that's the headline and then just make an edit. But yeah, that's definitely going to affect market prices and most likely energy prices. And what's the stock that we're running the wheel on? An energy company. So, you know, my bet, and another reason why I gave myself more time than usual, because as you can see, previous contracts, we were only doing like 4 days, 3 days till expiration. This one, I kind of gave myself more time because um, I just had a feeling that we can get a pullback. Like anytime you see the market go extremely like volatile, like just make a straight up move, like on what day was this? Monday. It makes sense that Tuesday we even gapped a little higher. We gapped from 1934 here and we to the 1997 open, and then we traded down a little bit. It's like I expected some pullback basically. I expected some pullback, and so I wanted to give myself more time because again, we don't. The goal is to not get assigned. I don't want to get assigned. I just want to generate cash on the generate income on the cash that I'm sitting on while we're holding cold shares. So we kind of maneuver around with this account. So I was just like, all right, let me give myself a little bit more time. And to be honest, I probably should have did a $21 put, but again, I think that we're going to keep the momentum. I think we're going to keep the momentum with the straight being closed, and also as per technical analysis, whenever you see, so I have the EMAs here, 9 EMA close, 21 EMA close. The 9 EMA and the 21 EMA, that strategy is called the Golden Cross strategy. So the goal is when you see the 9 EMA cross the 21, that's kind of like a signal that momentum is going to continue. So, it happened here early March. You can see we have it across the yellow, across the blue, and then price actually did continue going down for a little bit. But what do we have here? What do we have here? We see the yellow cross the blue again, but this time to the upside. So pay attention here. So, it makes sense that we can get a potential pullback, but I want to see how price is going to trade this week because I feel fairly confident that I'll be able to keep the premium on this one and not have to get assigned. But we'll have to see. We'll have to see. And just so you know, the rules I'm trying to follow is like 75% of profits. 75% of profits. So we got paid $350. Taking 75% of that, I'm just looking to only make $262. So we sold to open $350. I want to buy to close. I mean, even if it costs me like $100 or $1 and some change, it'd be fine. It'd be fine. Because we want to make at least 262 on premium for this contract. So this is pretty much where we're at. As you can see, if we go back to the main page here, this is where we're at. We got some buying power. I actually like how, so like on the income, on the sales that I did earlier, I want to see my cash position. Why can't I see my cash? I think I started out with I had like $1,700 cash, but now we're sitting on like $2,200 cash just from all the premium we've been collecting. So I like that. I don't know why it's not showing me. Oh, here we go. Here we go. Yeah, so we started at like $1,700 cash when we got assigned for Kohl's, and now we're sitting on $2,500 cash. So, I'm happy with that. The goal is to keep doing this, keep running this wheel. I'm pretty confident that Kohl's shares are going to recover like kind of sooner than later at this point because even with all the geopolitical risks going on with the war, and all the updates and headlines that we keep getting, the market is just going up. Like we're in the middle of a war that's marking history, and the market loves that shit, right? So that's a little weird, but the you don't want to go against the grain. Like you don't want to fight the market too much because you're gonna end up getting the market can remain irrational longer than you can remain solvent. So for that reason, it's not in your best interest to be the person to try to predict the next black swan event. Like there was the Michael Berry guy in 2008 who predicted the people were going to default on their mortgages, and it was going to send the mortgage-backed security market tumbling. It's like he did a lot of research in terms of looking at the actual securities and what was in them. He did a lot of research to be able to come to that conclusion. And even then, like predicting a black swan event so that the market can crash 30%, like it's not in your best interest to try to bet in favor of these events. Like if you think that the market's going to crash 30%, 20% or whatever, you really have to have a good reason. Like look at this, let me actually look at the S&P 500 be a better. Look at this V-shaped recovery right now. Like with all the things that are going on in the war, I forget when we announced the war. I know it was this year. I don't know if it was February or March. But you see, when we announced the war, the market started trading lower and lower and lower out of fear. Look how fast it came back up, though. Like to me, it's concerning kind of because it's like now we're at all time highs, like literally all time highs for the S&P 500. Look at this weekly chart here. So I think that if we can keep this momentum, um, you know, retailers like Kohl's are going to recover indefinitely. So I'm holding on to my Kohl's shares, and then while we have this volatility, we'll be collecting premium. But like, this is how look how crazy. It's like how many days in a row? One, two, three, four, five, six, 7, 8, 9, 10 days in a row green. 10 days in a row green. So it's like, why would you want to bet against this? And then here you see the golden cross strategy again, the yellow cross and the blue, and it crossed back here, and then you can see just immediately the price just goes higher. So it's like I wouldn't be the person who tries to bet against this. If the market's going up, just just go with the flow, follow the money always, and then you'll be a much better investor and trader. But that's where we're at. That's where we're at for in terms of this video, this account. We're here and interested, excited to see what's going to happen this week. And we got our options expiring this week. Oh yeah, I wanted to show you the last thing that we are actually down on this option. So you can see we got paid. Where is it exactly? We got paid $1.75, but currently the contract's going for $1.95. So we got paid this. If I was to close it, I'd be losing the 20 cents here. So the goal is for the market value for the contract to come lower, and that will happen when the underlying price goes above $22, and I'll be able to collect more premium, and I'll be all happy and shit. And that's where we're at. That's where we're at. Um, oh yeah, just so you can actually physically see what I'm talking about. We got paid. We got paid. What was it? 350. If we wanted to close this trade right now, we have to pay 420, which is a loss. So not trying to do that, but I think we're gonna have some bullish momentum on this contract, and then we can always roll. But I'm gonna see. I don't know if I need to give myself more time yet. Um, so I'm just gonna see how price action like opens up for the first couple days this week, and then just if I can get my 75%, I'm out, and I'm going on to the next one. I think that's about it. All I wanted to cover. I think that's about everything I wanted to cover. Yep, so now you're up to date. You know my future plans. We're just gonna do that. We're just gonna execute on that, and then hopefully we can get above back to our original starting money, which was $7,500. But based on the premium, honestly, like based on the premium that I've been collecting, Coles doesn't even need to reach our cost basis to get our money back because I collected at least like $700 worth of premium. So Coles can get back to like $17 and I'd be up on my money. But I want to free up the collateral. So I'm not going to sell the shares until it gets actually above my cost basis, which was $19.36. So you can see here. Yep, $19. Or sorry, $19 flat. I'm not going to sell those shares under that price because I would be losing money on the shares. So we'll till next time. Till next time. We'll see what's going on next week, next couple plays I'll make, and then we'll talk about it. We'll discuss. Leave some comments, like and subscribe. I'm gonna try to keep this series going for as long as possible. I actually really like this strategy, the wheel strategy, because it's like you have so much control over your risk, and like I really like that in comparison to like day trading that I traditionally was did a lot of. And day trading is a lot more riskier just because like you're just betting in the direction, but not just betting in the direction. You have to kind of get the movement correct because you can be right in terms of like you think the market's going to go up, but price will sweep your stop loss first and then it'll go higher. So it's like shit like that doesn't happen in options and selling options because everything is based off the expiration date. So it's going to be like it's based off what is the price of the underlying by the time it expires. So you have a lot more control over your risk, and then you can close it early. Like let's say if price moves in your favor very quickly, you can just close it early and be able to collect like 75% of your profit. The only downside to this is your profits are capped. So like for example, if I try to sell a put, um, I can only get the max amount of credit that was available to me, which as you can see is 35 or like in the last trade that we made was $350. So like that's the max profit I can make, right? And then the shares get put to me. And if I believe that the stock is still going to be bullish, I can just hold those shares and grab that appreciation and then sell it at the higher price. So you have a lot more control over your risk versus something like day trading. And then zero DTE options, I'm never really gonna mess with. Never gonna mess with that. But eventually on this account, maybe I will find a way to like creative ways of like selling finding ways to like purchase calls without actually using my own money. So maybe I'll do like a multi-leg strategy where like I'll sell a put and like use that premium to like buy a call or something. But you'll have to be really bullish on a stock to do something like that. But you can get a lot. You can get very creative with options. You can get very creative. Right now, I'm just kind of keeping it simple, and you guys can see exactly how options works in practice. So I think that's really cool. But enough yapping for me. I'll see you guys in the next one. Peace.